Here's how I like to set up the fund level return calculations. It is best to always have two contribution columns, one with negative values for capital calls and one with positive values for the return of contributions. This lets us keep track of what's really happening with some of these cash flows. Like in March 2020, we have offsetting positive and negative contributions due to new investors coming in at a final closing and paying off the earlier investors with notional interest. And in 2021, we had the fund returning a bit of capital because they called too much in the prior quarter. These little details will be appreciated by the future analyst who becomes responsible for this model about 5 years from now. The third column here includes the distributions. The fourth includes the fair market value after deducting carried interest, and the net cash flows on the right sum these four columns to provide the net IRR of 14%. This format also gives us net multiples. The DPI comes from distributions divided by net contributions, the RPI comes from fair market value divided by net contributions, and the TVPI, or net multiple of invested capital, is the sum of distributions in FMV divided by the net contributions. A quick side note here, many GPs are a little sloppy about distinguishing between returned contributions and distributions. They can usually get away with it because that distinction has no impact on the carry calculation, the preferred return calculation, or the net IRR calculation. However, improper classifications can cause errors in these net multiples down below because they can cause capital to be incorrectly attributed to a numerator when it should be in the denominator, or vice versa.